Right, so now we're going to move into the final session today, and really super to have such a cracking topic to finish on. So I'd like to first of all warmly welcome, I think I see her on screen, I'm sure she's, yeah, there you are, fantastic. Bo, welcome, huge welcome to, I know you've been here, but just welcome specifically to this panel. So Bo Bian, and I hope I've got your surname correctly, forgive me if I haven't, Assistant Professor of Finance at the University of British Columbia, Sauder School of Business, and her research focuses on issues relating to productivity, innovation, bankruptcy, and the interaction between regulatory, legal, and political economy factors with financing and investment. And her presentation today is focusing on work she's been doing with her co-authors on conflicting fiduciary duties in the sale of VC startups. So a fantastic topic. And let me just briefly introduce Bo's discussants. So first of all, Professor Luca Enriques, who is Professor of Corporate Law at the University of Oxford. And Luca, of course, is also a fellow research member and indeed board member of the ECGI, and has published widely in the fields of company law, corporate governance and financial regulation. And our second discussant, who we heard from just very recently there with our keynote speaker, Professor Robert Bartlett from Berkeley Law School, where he is faculty director of the Berkeley Center for Law, Business and the Economy. And he's also a founder and program co-director of Startup at Berkeley Law, which is Berkeley's primary platform for training entrepreneurs and investors. So a terrific panel to take us into our last session. And I wouldn't be doing my job properly as a chair if I just gave gentle reminders all around as to in and around 20 minutes, then we'll have our 10 minutes for our discussants, and then we can close this super afternoon with our comments from our colleagues on the call. So Bo, over to you. Very much looking forward to it. If you need to share your screen, please, over to you.
Yes, so let me share my screen. I hope you can all see my screen here. And of course, thanks a lot, Niamh, for the wonderful introduction, and good morning. Actually, good afternoon, I guess, for most of you. Good afternoon, everyone. And thanks for having me here and having the paper on the program. It is great to see a very lively law and finance debate here. So today I'm going to talk about conflicting fiduciary duties and file sales of VC-backed startups. This is joint work with a PhD student in Xiangli from UBC and Casemiro from Frankfurt. Both of them are in the audience today. All right. So let me start. So a few months ago, in October 2021, one of the largest venture capital funds, the Sequoia Capital Fund, made the following statement. Once upon a time, the 10-year fund cycle made sense, but assumptions it's based on no longer holds true, curtailing meaningful relationships prematurely and misaligning companies and their investment partners. So what Sequoia decided to do is to break the traditional fund cycle and restructure itself around a singular, permanent, open-ended fund so that Sequoia will not be forced to exit from its investments too early. So this is considered as a quite radical change because traditional VC funds have a limited lifespan around 10 years, meaning that VCs will need to liquidate the fund and exit from all their portfolio companies by the end of this limited lifespan so that they can return proceeds back to their investors, the LPs. And the most frequent exit method here is acquisitions. And having very timely exits is important, allowing for VCs to return cash to their investors and to build reputation with those investors so that VCs can raise capital from them in the future. However, the limited fund lifespan can really cause pressure to liquidate and misalign the interests of different shareholders here. In particular, when we have a lot of pressure to divest, exits through acquisitions are likely to be rushed and achieve lower sale prices. What this means is that while the deal value can still meet the downside protection provided by liquidation preferences in VC's preferred shares, common shareholders might end up with little or nothing. All right, so this reflects a more fundamental conflict of interest between the preferred and the common shareholders in VC-backed startups because they have different investment horizons and different payoff functions. So in a typical VC-backed startup, we have the founders, the entrepreneurs being the common shareholders. Those are common shares, equity claims with the full upside potential. And on the other hand, we have the VCs who typically invest through convertible preferred shares, and those are shares that come with a lot of special rights. And one of the most important special rights is liquidation preferences, which basically gives the preferred shareholders downside protection in bad states of the world. At the same time, an important feature here is that both the preferred and common shareholders are going to appoint board of directors of the VC-backed company, with very strong board control often given to VCs. And those board of directors are going to oversee the operation of the company, including initiating key transactions such as mergers and acquisitions. However, those VC-appointed board members or the VC-controlled board have dual fiduciary duties here. So on the one hand, they are accountable for the corporation, and for the common shareholders, they have to maximize the value of the corporation for the benefit of the common shareholders. But on the other hand, they have very strong financial incentives and are under contractual obligations to also maximize return for the VC fund and for its ultimate investors, the LPs. So essentially, we are two hats here. So luckily, the dual fiduciaries are aligned in most occasions. However, they may also diverge in some key scenarios. And one prominent example here is during exits through acquisitions, which is going to be the focus of this paper. And those controversial transactions have already been triggering litigation on fiduciary grounds in recent years. And what happens typically in those cases is that VCs with preferred shares, they are going to force an exit by acquisitions over the objections from common shareholders. And of course, the common shareholders are not going to be very happy about it. They are going to sue the board for breach of fiduciary duties. So in light of the heated legal disputes, we raise the following research questions. First, are the sales by maturing VC funds indeed underpriced and costly to common shareholders? In other words, we are asking, are the evidence consistent with file sales in this VC setting? If the answer is yes, given the conflicting nature of the dual fiduciaries, the legal environment here will matter a lot. So does the court support common shareholders when they sue, or vice versa? More importantly, can corporate law actually shape common shareholders' hold up power against VCs, and then in turn discipline VCs' behavior in those exit decisions? So this paper aims to answer all those questions by examining sales of VC-backed startups over the life cycle of a VC fund in a changing corporate law environment. And more specifically, we are going to exploit an important Delaware court ruling in 2013. This is the Trados division, which establishes the rule of common shareholder value maximization. And the ruling can be largely understood as moving from a more preferred favoring regime to a more common favoring environment. So what do we find with this setting? So let's have a quick preview of the key findings of the paper. So we first find that the transactions by VC funds under liquidity pressure are characterized by the following three key features. First, we see a substantially lower sale price for those transactions, up to around 30%. And second, we also find that those VC-backed startups are more likely to be acquired by industry outsiders when there is a lot of liquidity pressure, including financial firms and most notably private equity investors as the acquirers. And third, there is also a positive abnormal return for acquirers around the deal announcement, suggesting that the acquirers are actually taking advantage of the target in those cases, and part of the target's loss actually become the gain of the acquired. And taken together, all three pieces of evidence point to the existence of biocells in the VC setting. And we know that those cells under VC syncretic pressure are on average value destroying, especially for the common shareholders who are the residual claimant here. And this seems to be changing, however, after the Trados ruling. So we already mentioned that the Trados ruling established the rule of common shareholder value maximization, which basically gives more power to common shareholders to challenge or to hold up the sales on fiduciary duty grounds. So after Trados, we find that maturing VC funds, so the VC funds under a lot of liquidity pressure, are less likely to exit by fire sales. And accordingly, because of the reduced proceeds from those sales, they are paying back the investors, the LPs, less timely. At the same time, very interestingly, we also find that VCs experience more difficult fundraising, presumably because they cannot easily offload the investment by acquisition as much as they could in the pre-Trados years. Ultimately, this speaks to the trade-off of fiduciary duty design. Taken together the results here. On the one hand, you might reduce value destroying fire sales, but this might also discourage investors and come at the cost of reduced venture capital supply. All right, so this is kind of the basics of the paper. Now I'm going to give you more details about the setting and the specific evidence that we find using the setting. The empirical part is going to unfold in two parts. In part one, we are going to provide evidence consistent with VC fire sales, the existence of which would pinpoint the preferred common conflict and the looming dual fiduciary duty issue. And in the second part, we are going to talk about the effect of trials. All right. So one key starting point here is the limited fund lifespan of the VCs. And you might wonder, is this contractual lifespan indeed a binding constraint on VCs' exit decisions? Can we take it as given, or where does it even come from? So limited lifespan is typically fixed ex ante in the contract between the GP and LPs. This is called an LPA, Limited Partnership Agreement. And the contractual structure there, the limited lifespan there, is the equivalent outcome of an agency problem that balances the following two things. So first, the GP or the VC firms are given the control of the capital and a sufficiently long investment horizon to make decisions in a fast-changing business environments. But on the other hand, the LPs also want to avoid being held up by the GP once they have given up their capital, once they have committed to invest. And the fixed term provision basically will subject the VC's performance to a market assessment so that the LPs will get more information about the performance of the fund. And speaking of the very origin of the short fund lives, some people have traced back to the norm in limited partnerships of many other different types, including real estate, including oil and gas exploration, and also shipping. And the uniform and persistent lifespan has been observed over the past several decades. And this is actually quite puzzling, given that we observe the maturation of firms across industries over time are going to be very different. Trying to investigate, the reasons behind this puzzle, why it is so uniform and persistent, always around this 10 years, is beyond the scope of the paper. But the observation encouraged us to take the limited fund lifespan as given, at least during our sample period. How about renegotiation between the LP and GP? To start with, there is limited extension. So this is LPAs typically allowing the extension for up to 3 years in 1-year increments. And this has to, of course, subject to LP's consent. And according to previous work, an average of 2 extensions, 1 year each, is granted if the majority of the LPs agree. So there is admitted there is limited, very limited extension here. Further extensions or renegotiations are super unlikely. As mentioned by Goethe and Lerner in 2001, unlike other agreements, those LPAs are really renegotiated. It's very different from like employment contracts or strategic alliances. Those contracts are not very flexible. And there are other work relying on binding limited horizon in the literature. For example, there is work to study secondary buyouts among PEs using binding limited horizon, as well as VCs investments in innovative companies. So very briefly on the data source and on sample, we start with a cross-section of VC-related acquisitions with deal characteristics, and we rely on two data sets here. One is Friction, which gives us information on venture capital deals, and the other is SDC Platinum, which gives us the acquisition-related information of all those VC-backed companies, including the deal value and the industry and financials of the acquirers. And we, in order for a firm to enter our sample, we require that firm to be, that company, that VC-backed company, to be acquired by the end of 2020. So this is an acquisition-only sample. All right, in the language of Schleifer and Wishy, fire sales are forced sales at potentially dislocated prices. So to provide evidence consistent with fire sales, we first need to identify what are those forced sales. And more importantly here, we define forced sales as sales close to the end of the conventional VC fund lifespan. The key here is to figure out the age of the VC fund when the transaction takes place. Merging SDC Platinum and Friction will help us to get to the vintage year of the VC fund and the exit date of the portfolio company, and the difference between the two will be the age of the VC fund when the transaction takes place. And then for each fund company pair, we're going to define if the transaction is forced or not. And the definition here is very similar to Campbell et al., the 2011 ER paper. And we define this forced dummy, forced minus T plus T equal to 1 if the transaction takes place within 2 years of the end of the VC conventional lifespan and 0 otherwise. And we allow this T to vary from 1 to 3, and this window length basically will capture the urgency of the transaction. And importantly, we choose the conventional lifespan to be 12 years here. And you might think this is a little bit arbitrary, but there are 2 reasons behind this. We choose it both because of anecdotal evidence in the literature and also patterns from cash distribution for those VCs. So first, VC funds usually are organized to have a limited lifespan of around 8 to 12 years with the option to extend it for 1 to 3 years. We take the average here, 10 plus 2, so that gives us 12 years. And second, if you look at the figure here, which gives you the cumulative cash distribution by VC fund age, you can see that indeed most of the cash distribution, 93% of the cash were distributed in 12 years since vintage for a median fund. So the solid blue line here is for the median fund, and by age 12, 93% of the cash were distributed, and by year 15, 100% will be distributed. And if we try to see the tails of the distribution, sorry. If you try to see the tails of the distribution, you will see that indeed the speed of the distribution will catch up around year 9 and year 10. So that kind of gives us a lot of confidence in choosing those cutoff as the liquidity pressure increasing years. All right. So very briefly on the empirical design here. We have the sample being found startup company cross-sectional data, and we conditional on acquisitions by the end of 2020. And this is the main regression equation for the fire sale evidence. And on the y-axis, we have 3 different variables: either deal value, deal multiple, acquired industries, or acquire abnormal return. And on the right-hand side, the key variable that we're interested in is this forced dummy, which basically indicates whether the transaction happens under liquidity pressure. We include a lot of controls, a lot of fixed effects, just to make sure that the companies are more comparable when we get to the coefficients. Okay, so enough on the setting. Let's now move on to the results of the paper. And this table here gives you the regression when using a value of the deal value or deal multiple as the outcome variable. So very obviously, if you look at column 1 to 3, you always see a negative coefficient on the forced dummy, indicating that there is a discount associated with transactions under liquidity pressure. For example, if you look at column 1, this actually translates into a 31% discount for sales in the final year of the conventional lifespan. And moving from column 3 to 1, you can also see that the effect increases when the urgency of the transaction increases. And you can find similar things when we move to deal multiples at the outcome variable in column 4 to 6. And this is also evidence for the undervaluation of the company. And you might wonder what can account for the undervaluation of the company, so why that is taking place. And we further try to investigate the acquirers, what the acquirers are getting and what are the identity of the acquirers. So this is by looking at the industry of the acquirers to see whether they are coming from a more remote industry or coming from a closer industry that might have better use of the asset and might have just a higher valuation of the asset. And the outcome variable here is this remote industry dummy in column 1 to 3, and you can see that we always find a positive coefficient, suggesting that companies in forced sales are more likely to be bought by acquirers in those remote industries who are unlikely to have the best use of the asset and have the highest valuation of the target. And in column 4 to 6, we look at financial acquire indicator. And again, you see very positive and significant coefficient, suggesting that those companies are actually more likely to be bought by financial acquirers. And again, financial acquirers are likely to underpay because they are not the specific asset users. And we interpret this as evidence that assets are not really sold to the highest value bidders. And on top of this, we then look at the acquire announcement return to see if a part of the acquirer's gain is because of the loss of the target. So the outcome variable here is a cumulative abnormal return in the 10 days around the deal announcement. And we use 2 benchmark models. One is CAPM and the other is Pharma French 3 in column 1 to 3 and column 4 to 6. And across all specifications, you can see that there is a positive and significant acquire abnormal return, which also increases with the urgency of the sale, indicating that indeed the acquirers are gaining at the cost of the target that are sold at a discount. By now, you might have this question in mind already that, okay, the firms that you are comparing, the startups that you are comparing that are under liquidity pressure, that are not under liquidity pressure are probably different. So to be more specific, there might be an unobserved value or quality difference between startups sold earlier versus later in a fund lifespan. And this is a so-called quality discount story that the VCs might simply wait on bad startups, and this might explain why there is a discount to start with. So to address such selection concerns, we did a couple of things. I don't want to push it super far here, but we do interpret our evidence more consistent with fire sales instead of quality discount. So the first thing we did is to try to control for the quality of the firm as good as we can. So we merged the data with more kind of a census style data set for US companies, try to see what are the sales, what are the employment, what are the future growth opportunities of the firms that are sold earlier versus later. And we add that as control in the regression. And you can see that across all those different specifications for different outcome variables, we still observe a very significant and very similar results as before. And second, we also try to look at post-money valuation. And we find that, and we use that as a proxy for quality too. And we find that valuation for startups eventually sold in forced and non-forced sales are not really fundamentally different. And then we also use exits via IPOs as a potential counterfactual here. And we didn't see the discount in IPOs when VCs are under liquidity pressure. And finally, one thing that I should emphasize is that selection on quality cannot really explain why there is a greater probability of being sold to industry outsiders and why there is a higher abnormal return for acquirers, because those are rather unique markers for file sales. So to conclude here, we interpret the evidence really consistent with the existence of file sales. And there are some additional interesting results here. For example, we find that this file sale results actually vary with industry conditions, where there is a lack of demand from high valuation buyers in the same industry. So when an industry is in cold markets, we find that all the effects are going to be more significant, are going to be more substantial. And then we also find evidence consistent with intra-VC conflict of interest. The idea here is that VC's incentives might be very different because of their different investment horizons, because of the different liquidity pressures they face at different stages, and one company are going to be invested by multiple VCs. And when there is a lot of conflict among the VCs themselves, which we proxy by the age dispersion of the VC funds, we do see that the file sales are actually going to be mitigated. The file sales are becoming less likely, and all those other phenomena that we see are becoming less significant. This is because some of the younger VCs who are not under the liquidity pressure are not going to be agreeing with the file sales. We did a battery of robustness checks in the paper. I'm not going to discuss the details here, but we did try, different regression specifications, different sample selection criteria, and the results always goes through. All right, so far I've been talking about the transactions of by VC funds under liquidity pressure, having all those very specific characteristics. And you might wonder, the next question is, can those file sales be avoided? Are there any legal solutions to, target or to address some of the file sale scenarios? And the key issue here is VC's lack of regard for common shareholders, and that's why we're going to focus on the Trados decision, which is considered as a common favoring ruling, to see how that affects the behavior of the VCs, especially in the exit decisions that we have been focusing on so far. All right, so this is the second part of the paper, which is specifically on trials.
Oh, well, I'm so sorry to cut across you. It's a super paper with really rich analysis, and I'm very anxious to bring in the discussants and the colleagues from the call. I wonder, could you possibly maybe 5 minutes to cover all?
Yeah, I can finish it in 5 minutes.
Super. Thank you so much.
Yes, no worries. So yes, given the conflicting nature of the two fiduciaries, the important question is, what was the Delaware Court's take on this issue before trials? In other words, whose interest would prevail in potential file sale situations? And this was the court ruling in 1997, which basically says that a board can certainly deploy corporate power against its own shareholders, and this is a situation before trials. And this is consistent with the contingent approach theory. Basically, VC-controlled board can make decisions that favor preferred shareholders at the expense of common shareholders, and the court will respect all those special rights created for the VCs for their preferred shares. And as a practical matter, this is interpreted as a pro-preferred regime. And then we have the Trados case and the Trados ruling. I'm not going to give you much details on that. The main takeaway here is that the common shareholders are sued, and after closely examining the case, the court come up with this. The court concluded concluded that the traders board was indeed conflicted, and then they endorsed this rule of common shareholder value maximization in August 2013, which moved the legal environment from a more pro-preferred one to a more pro-common one. And there are a lot of responses and comments following trials, but there hasn't been much empirical evidence so far. So this is where our paper comes in this more trials environment context. And the empirical design here is slightly different from the previous one. Here we have a definitive setting, and our interest is to examine the change in the probability of exits through acquisitions by VCs with and without liquidity pressure before and after trials. And what we find is that in terms of the baseline results, trials indeed lowers the probability of fire sales, the probability of sales happening under the liquidity pressure of the VCs. As you can see in this table, the coefficient on the interaction term is negative and significant, suggesting that the trials is going to mitigate those fire sale scenarios. And one concern you might have is that could this be driven just by the more founder-friendly environment after 2010 and the influx of capital into the VC industry? Here we try to examine Delaware incorporated corporations versus non-Delaware incorporated corporations to rule out this concern a bit. So the idea is that in the end, Trados is a Delaware ruling, so it should be applicable more to Delaware incorporated corporations, while the wider change in the VC business environment, in the capital environment, is applicable to every single firm, regardless of where they are incorporated. And indeed, we find that Trados is a Delaware opinion, and consistently we see stronger effects if the companies are incorporated in Delaware. So the triple interaction term has a negative coefficient, suggesting stronger effect in Delaware. And because of the fewer sales, we also see that there is less timely distribution to LPs. And here you see the negative coefficient indicating less timely distribution to LPs after trials for the forced sale cases. And in terms of dynamics, we see no pre-trades, but a significant and negative post-trend, consistent with trials being a surprising yet a very important event. Final results, we look at the accenting effect of VC fundraising. The worry is that, of course, it's going to reduce fund sales, but then it might have a chilling effect on fundraising because the interest of the VCs and the LPs are going to be hurt. And here we look at, we are looking for evidence consistent or trying to verify this worry. And we find that foreign LPs will reduce the allocation to US VC funds after the Trados ruling. This is presumably because the foreign LPs are investing in US VC funds precisely because they want to take advantage of the more favorable legal environment in the US. And when that is being weakened, they withdraw and they allocate their funds more to foreign funds. And as a result, we also see US funds experience a decrease in fund size. So this is here in column 5 and 6. All right, I'm not going to spend too much time on the literature and contribution. The paper links 3 different literatures: law and finance, VC asset literature, and the fire sale literature too. Now, let me just quickly conclude. So in this paper, we are studying the evidence consistent with fire sales in the VC setting, and we find that there is indeed suboptimal transactions in presence of fiduciary duty conflicts, and an important court ruling can actually change the dynamics of fiduciary duty conflicts. Overall, our results highlight the complexity in the evaluation of Trados and in the resolution of inter-shareholder conflicts, and have important implications for optimal fiduciary duty design. Thanks a lot. And I look forward to the comments from both Luca and Robert.
Oh, that absolutely tremendous. I mean, right at the end of the conference, to have a paper of such richness and depth, really, thank you so much. And also to your co-authors, who I know are on the call as well. So I'm going to go in alphabetical order for our distinguished discussants at the end, and I'm going to start with Professor Bartlett. We've been having a sort of a conversation in the chat. So Bobby, you can apparently share your slides without being a co-host. So I've just checked that with Simon, so hopefully that will work.
Okay.
Hopefully.
Right.
There you go. Brilliant.
Okay. Well, thank you so much for allowing me to discuss this very interesting paper, and thank you as well for making it late in the day, given the time zone difference. I like this paper very much. I think it's an important research question with regard to the effect of funds defined life on the incentives to try to engage in a fire sale of its portfolio companies. It's a super clever and ambitious research design too. So I just want to spend a minute to just sort of compliment the authors on the laborious effort that went into this design. So this is the Preqin data, for instance, that I assume this is a big data set. And so you see sort of the portfolio companies here, you see the investors. And what's really novel is they actually don't focus on the management fund, they focus on the fund itself. And so that's what's unique to Preqin, as you can see this. And so then they have to sort of translate this into a fund company pair, and so that sort of allows them to sort of examine this question, but that of course requires them to figure out, okay, well, what is the life of Alpha Tech Ventures 2 and Japer Fisher Jurgensen 10, and where in the life was this investment made? So that's hard to do, and so I really just want to compliment the authors on that. So I think that in itself is a huge contribution to the literature. The main challenge, as is typical in entrepreneurial finance, is identification. We have cross-sectional regressions to work with. It's really hard to sort of satisfy the identification police. My solution is going to be exceedingly careful on interpretation and framing. I think that's one way to try to lessen the resistance for the readers. And there's really two primary stories that are told in terms of it's the causal story. It's sort of a soft causal story in both. So one of them is that a VC fund holding a portfolio company at the end of its life is going to force the company to be sold in a value-destroying transaction. So that's sort of the fire sale discount story. And the second story is about Trados, which is that Trados gives common stockholders sort of this additional power to sort of push back on these fire sales, and that causes the funds to react and be more cautious in if they engage in these fire sales. So I want to explain why I have some concerns about both these stories, and how I would tell the story, in at least absent additional data and analysis. So here's the primary empirical specification for the fire sale story, and Luca is going to focus on the Trados story, and so I'm going to spend most of my time on this fire sale story. So the comment number one that I would have is, are you asking for unnecessary resistance with this specification? And what I mean by that is, if we go back to that Preqin data, and if we just look at Planet Labs and Equilibrium Solar, and we sort of look at what the panel problem, what your data looks like, Planet Labs basically gets an enormous weight in the regression, and so naturally my thinking is, geez, you're gonna, if Planet Labs is somehow sort of, if all the funds in Planet Labs are sort of at the end of their life, Planet Labs is gonna have this outweighted effect on the regression coefficient. And so I spent like the first 20 pages being like, this is really worrisome. How am I gonna get comfortable with this? I don't know what the distribution is. And then you eventually sort of adjust it. I think it's like 22 pages into the paper, you say, okay, we do run it based on just sort of the first investor. And so I said, okay, well, I'm glad they did that. I would almost encourage you, maybe make that your primary specification, just because I literally spent the first 20 pages like worried about the potential bias that could result from this design. Okay, so it comes up in a couple of places, like I say, look at you have 1,300 observations in terms of deal values. Why are your observations so much bigger in tables 2 and 3 when you're sort of running the regressions? And it's because each company is in there about 2.7 times. So ideally, what you would do is have sort of a weighted average measure of sort of liquidity pressure. And so that would, ideally I would take sort of, the stake of each of your funds, and then you would sort of figure out, okay, well, where in the fund's life was it made, and then come up with a weighted average. I don't know if you can do that, but that would be sort of, I think, an ideal solution if you want to keep the current organization paper as it is. The second comment I had is, does your beta coefficient really estimate a fire sale? And this really gets to the question of interpretation and framing that I'd like you to think about. So this comes from, in some sense, the theory that underlies the paper, which is, do VCs sort of have the motive and the power to force a fire sale as is characterized in the paper? So first, when we look at what is a fire sale? So in the paper, you say sort of a couple of different ways that basically, this middle one, we find that maturing VC funds tend to carry out fire sales that satisfy VC's liquidation preferences, but sacrifice common shareholder interests. That tells me that you see a fire sale as the VC gets his liquidation preference and the common stock gets whatever's left over, if there's anything. So there's no conversion. Okay, so that's a pretty bad outcome for a VC. And so the question is do VCs have the motive and the power to actually force that type of sale? So first of all, in terms of just empirically, like, do you observe fire sales in the data? I don't know. When I look at sort of, table 1, the deal multiples, it's on average 7x. The money comes back. The median is almost 4 times. Your coefficient estimate, I don't know what else is going on in terms of your average effects here, given all the covariates and your fixed effects. But at least the initial coefficient suggests that actually, these VCs actually are still doing okay. They're still getting more than their money back, given sort of the average multiple that you're seeing in the data set. So I would like to see whether or not, what are the actual distributions on common and preferred to establish whether the fire sale as it's defined is actually occurring. Even if we sort of go with that, going back to the motive, one is a 10-year term on funds actually at binding? And this actually surprised me because in the course of preparing for these discussions, I was going back in time. I looked at the 2015 NVC yearbook, and they actually provide this table, which indicates that the 10-year timeline is pretty fuzzy, and it's almost as if there's a lot of leeway in going past it, which actually makes a lot of sense if it's the case that having a binding 10-year fund would induce premature exits of companies. And I come back to this in a minute, because it does go to sort of how the LPs would view this scenario. So from the VC's perspective, I would sort of also think, well, why would the VC wait to sell a firm at less than fair market value? It's not as if the 10-year term is like a surprise to them. They don't wake up and be like, oh my gosh, we're at year 10, we've got to sell. I mean, they kind of know it from day one that, we have 10 years to sort of get the work done. And, they know this. And so in some sense, like, why are they waiting? Why don't they sell the firm earlier if they can do so at fair value? And so this, the VCs will face a clawback position as well if they aren't getting top dollar for the portfolio company. They sell it just at, say, its liquidation preference. And even in Trados, Wachovia, for instance, like they got a return on capital. There was an accruing dividend, and so actually most of the investors had a positive ROA on that deal. And then also the VCs, if they really think that the 10-year term is going to have this effect, then the LPs, they'd be like, well, okay, that's bad for us, and so they would then respond accordingly, which may explain why that table in the yearbook is what it is, why it's the case that 10-year term is not actually all that binding. In terms of power, do VCs actually have the power to force a fire sale as defined? And here, this you acknowledge this in the paper. I think it's a real issue though, which is the VC share board power with one another, with founders. VCs have a lot of conflicts, in part because of the different times at which they invest, the different prices at which they invest. And VCs are aware of these conflicts. These are not a surprise to them. And so in an earlier paper, I studied on, I sort of looked at this, and there's, classic case, benchmark capital be vague, where it's actually the late stage investors that they prevent benchmark from wanting to sell the company, which is, so here is the early stage investor. Investors want to sell, but they can't because the late stage investors had negotiated for a veto right because they acknowledged the conflict of interest they had with respect to the incentive to liquidate versus continue the firm. So all of which is to say, I would be reluctant to call this variable a forced variable, because I don't think you can say that. I think the most you can say is this is a fund is maturing variable. And that is what we've detected, is we have detected a relationship between sales at the end of a fund's life and valuation. And I think that's fine. I don't think you're gonna get pushback on that, but I think calling it a forced variable is gonna engender resistance. The third comment is, it goes to this quality story that I know you focus on a lot. I think that's exactly the thing to focus on. The issue is really, is the timing at which a sale occurs, is the covariance with error term really zero, and especially given the sample period. And the problem is again, because it's a cross-sectional analysis, people are going to be able to tell all sorts of stories about why quality matters. And so here's one I'll just come up with. Okay, so if you look at sort of your sample period, what you see is this enormous spike in VC fund formations at the peak of the bubble, and the returns on those funds were abysmal because they were invested at the peak. And note, 10 years after those funds were formed was a really, really bad time to sell a company because of the financial crisis. And so you sort of have this bias within your fund sample itself with respect to, what's happening at the end of a fund with respect to the portfolio companies they weren't able to sell prior to that date. Okay, so all of which is saying, I'm going to skip the trade-off stuff because I agree with Luca. There's one point, which is, I'll just say that your empirical design here was confusing to me because I would have just run it as a propensity, sort of straightforward propensity regression, where you look at the likelihood that a sale occurs when a fund is in its end of life. I'm a little worried what you're going to find because you don't see any bunching at year 10, which is kind of what I would expect if that was to be a positive relationship. But I would encourage you to look at that. Overall, I think that this is a fascinating paper. I think it's super important. I would just be very cautious in how you interpret it. I think my intuition is that what you're seeing is a combination of a quality issue and an end-of-life story, which is that there's a reason why WhatsApp was sold only 4 years after its investment, right? I mean, it was a really great company. And there's reasons why companies take a long time to be sold and why they're in the fund at the end of the fund's life. So I can't think you can rule out the quality story. In fact, I think it's really important. But I think there is also an end of life story as well, which you've identified. And I think that that's fine. I think that's an important implication of having a binding 10-year fund. And I think that's in part why Sequoia is going to an evergreen fund. Because it does complicate how a fund can act loyally for its limited partners when it feels this pressure to sell these, these assets that it hasn't been able to sell up until the end of its fund life. Okay, so I'll stop there and let Luca speak. But overall, congrats on what is a really interesting and an important paper.
Thanks, Professor Bartlett. Absolutely tremendous. Thank you so much. Those are really rich, a huge amount compressed there in the slides. Brilliant. Thank you. So now, Professor Enriques, our final discussants. Thanks so much. Over to you, Luca.
Good, great. Okay. So thank you, first of all, to the organizer for having me to comment on this excellent paper. My discussion will be embarrassingly simpler than Bobby's. I am a legal scholar with no empirical skills, and he is both a legal scholar and a state-of-the-art empiricist. So you will see the difference, unfortunately. For me, I will also be brief as a consequence, and that I think will be well accepted by the audience at this time of the day in Europe. And I would therefore comment on only one of the many results of the paper, which reminds me that the numbers of results that are in this paper has reminded me something that Andre Schleifer reportedly used to say, which is if you have one paper, you have three papers. By that, he meant that once you have enough material to write a paper, you can write three with the same material. Here, I think the authors have three papers into one already. They could easily divide it into three. One, as Bobby said, is about fire sales. The second one is on the effects of traders on existing VC-funded companies. And finally, there is a paper on the effects of traders on post-traders VC funding. And my comments are actually only on this third quote-unquote paper on VC funding. So on the traders part of the paper, Bo and her co-authors find that traders had an impact on the behavior of relevant parties at firms funded by VCs before the traders judgment was issued, which was in August 2013. And they show that after that opinion was published, there were fewer fire sales, which means founders were better off and VCs correspondingly worse off. And this, I think, confirms the common sense intuition that an unanticipated change in the law that regulates a given existing contract will make one of the two parties stronger vis-a-vis the other, and therefore allow that party to extract a larger share of the pie exposed. But the authors also find evidence that Trados had an effect not on existing contracts, but also in a way on future ones, and they focus on U.S. venture capital firms to the ability of U.S. venture capital firms to raise funds, new funds from investors. And here, their result is, I think, less intuitive. So what they find is less intuitively, I think, is that there is evidence that post-Trados, the US VC market has become less attractive for foreign LP investors, those who have incentives to invest in their home market as an outside option. So they find evidence of this. And I have some doubts about it in the sense that they're compared to the number and ingenuity of the controls that they use for what I call the first and the second papers, in this part, and if I may say so as a lay person, the econometrics appear to me relatively less developed than the other parts of the paper. So there is an example of something that may have explanatory power. As I said, there's an example of the many things that may have happened in the years after Trados that may have affected non-US limited partners, investors' relative inclination to allocate their funds to US venture capital firms. So in this data from a Bruegel publication based on Bloomberg data tells us that between 2015 and the end of 2019, the value of venture capital deals in Europe more than trebled, while in the US it less than doubled. And so I think it stands to reason that European venture capital firms, investors, may have been less inclined to invest in the US market when their own domestic market was finally booming after decades of lagging much behind the US. And I would guess there must be fancy ways to control for this and for other similar market trends that may be observed both in Europe as elsewhere. But leaving the empirics aside, what I struggle to understand is actually the theory. So why would we expect Trados to affect future deals? We know that, and we have discussed this already throughout this conference, VC deals are highly tailored contracts. There is of course, some standardization, but not along the lines of the default rules of corporate law. And corporate law in Delaware, as we know, in the US in general, is ultimately enabling rather than mandatory. So one may immediately object that if there is one mandatory element of Delaware law, that's fiduciary duties, but and that is undoubtedly true. However, one may question whether there are really no alternative if this is not, if this is an important thing that can lead to less investment in venture capital. So, for example, a law firm memo from September 2013 giving views of this law firm Fenwick to its clients about the impact of Trados, argued that venture capitalists and entrepreneurs should look into whether the LLC form could be used, because in the LLC, in the Delaware LLC, there is so the fiduciary duties are optional, are default. The limited liability company agreement can say that they do not apply. And however, I must say that I found out that the LLC is not attractive to venture capital firms, mainly for tax reasons. So there might be reasons why actually, so there are reasons why there was no switch to the LLC. One other possibility is to exploit regulatory competition in the US. And so we know that VC firms in California use Delaware, but Delaware law. But if it is true that litigation is not that important for the VC contract, and most of it is based on reputation and self-enforcing provisions, then perhaps if Trados is indeed relevant, they may try and use Pennsylvania corporate law, which has a very pervasive other constituency statutes, the statute that make, again, the fiduciary duties of directors in the context of acquisitions, therefore sales of the company, any kind of sale, hostile or friendly, basically optional. And there is the text of paragraph section 1715B is pretty clear in saying that the interest of the shareholders can be just one that the directors may consider. And finally, perhaps these options are not really there. I may be wrong that the lawyers in Silicon Valley will ever consider anything else than Delaware law, with which they are familiar and which they will have to use at some point before going public, even though it's well known that companies do convert into Delaware companies before going public, so it doesn't seem to be an obstacle. But that also may be irrelevant because, well, Trados may have allocated a specific property right to common shareholders in the form of clarification of what the contents are of fiduciary duties of directors. But still, there are so many ways in which after Trados, the VCs and entrepreneurs can negotiate a different deal, which basically neutralizes the negative effects of Trados. And this is obviously an application of the cause theorem in a setting where transaction costs are intuitively low because parties can and do contract, as we know. And I'm not talking here about ex post bribing each other to accept or reject a deal, which as Saga and Telly have shown recently in a paper, may work only asymmetrically, so may not be a solution specifically for the entrepreneur. But what I'm thinking about is how ex ante the allocation of cash flow and governance rights may be altered to account for that change in the law, the Trados change. And perhaps here I'm a bit too naive in thinking that lawyers will always find a contractual solution to a corporate law problem, although that's what they have done quite effectively, as we said in the previous, as Tobias said before, in this context. And similarly, I may be naive in thinking that VCs are able to quantify the effects of that Trados may have on each of the parties, and therefore alter cash flow rights in ways that will neutralize the anticipated effect. And it may well be that we do not observe this having happened in the year after Trados, but that doesn't mean that it is not possible. It might be the case that in a boom market, simply the entrepreneurs were powerful enough in terms of being able to reject this VC firm or the other, not to for the VCs not to come up with less generous terms than Trados granted to the entrepreneurs. But I would argue that VCs and their lawyers do have the incentives and the experience to make good enough judgments about these things, and to experiment with new clauses if this is relevant, and incidentally, work like Bose and her co-authors can help them in this endeavor. So to conclude, congratulations on the excellent paper, the quality of which my minor and unsophisticated comments do not belie at all, and thanks for the opportunity to discuss the paper.
Thanks so much, Luca, and not at all. It was a typically nuanced and subtle end to our day. So thank you so much to you, and also to Professor Bartlett. Really great to see those two perspectives coming together, I think, given the nature of the dialogue we've been having over the last few days. I thought it was a wonderful combination of rich analysis there. But before I come back to you, I'm just having a look in the chat, because I know you're going to want to respond to our two distinguished commentators. And I think, why don't you start us off, Bo, with your reaction to what you've heard from our two discussants.
All right. Thanks a lot, Bobby and Luca, for the wonderful discussion. A lot of insights that we will take very carefully. And let me just probably in reverse order speak to some of the comments that were made. So first, in terms of anti-contractual solutions that Luca was talking about, I agree that it would be great if we can find evidence supporting that. It might take some time, although, for the parties to figure out whether there is legally binding, a very effective way out of this. In the earlier version of the draft, we actually have a more detailed discussion on some of the contractual solutions proposed by NVCA and why, we argue why they are unlikely to work. Now we are trying to also put together some empirical evidence by reading and coding contractual terms from a certificate of incorporations, COI data of the startup, trying to see whether there is indeed something in the data. And I like the point that you are making about whether they are switching to a different business organization form, LLC, or whether they might just get incorporated elsewhere to dodge the change in the legal environment. Our kind of understanding there is that the consideration for trials is probably not first order in the choice of the organizational form, in the choice of where to be incorporated, because there are tax benefits to be incorporated in Delaware, and in terms of LLC, there are complications for equity compensation for tax situations, and the lack of tax incentives when it comes to LLC, and so like. Putting that together, we think that it's probably not kind of a major factor in driving the different choice of organizational form and incorporation state. And also not to forget that, like the Delaware corporate law has a lot of expertise in like lawyers and familiarity with that legal environment, and that is also kind of of first order importance. And your first point is about empirical tests around fundraising, the final test that we have. And I'm glad that you see that, there are many results in the paper that can potentially be decomposed. So like we kind of face this trade-off, like whether we want to add more results to this final point, or we want to try to, make the previous points more solid. But for sure, we can try to do more tests around the final point you are making, including trying to rule out some of the concerns. For example, the domestic market is becoming, more attractive. And coming back to Bobby's comments, yes, let me just talk about a couple of them. So first, the 10, so one clarification at the beginning, we do see liquidation multiples larger than 1. So it's not always the case that they get the original maximum back, and that can probably be reconciled with the fact that we see this multiple, the deal multiple quite large. And second, you mentioned about the 10-year fund lifespan potentially not being binding. I'm glad that you pointed out, and I think that, you know, that is not kind of a uniform lifespan that will be applied to every single VC. And we also know that using this uniform number might not be ideal, but it's very difficult to accidentally figure out the precise information on this. A lot of the extensions are ex post, and we care about more kind of the ex ante setup. And our rationale of choosing a uniform lifespan is that having some noise in this measure will only make it more difficult for us to find results consistent with file sales. And also, I want to clarify that it's never our intention to argue that the covariance between the false dummy and the error term is 0. I guess maybe the language that we use in the paper is a bit too strong, and we did a large set of tasks, including the different outcome variables, controlling for quality, and this and that. And basically, we are trying to argue that the file sales story is there. It's very difficult, and I think it's impossible for us to completely rule out the selection story. The bottom line is that a selection is unlikely to drive everything that we see in the data. It has to be partially driven by the file sale story. And I agree with you that we don't really need to use a very strong language there. As long as the file sale story is part of the results, it is fine. We are fine with that. And in terms of the fact that we don't see bunching, we actually examine the figure quite carefully. Like, our conclusion is that it's quite difficult to know the counterfactual. So basically, what will happen, you know, like just because of business opportunities without all this liquidity pressure, and without knowing the counterfactual, I guess it's very difficult for us to see whether there should be bunching or not. And excellent point that you made at the beginning about the weighting issue and about the empirical specification. We did thought about that, and that's why we currently have a section on that. But I agree with you that maybe we should think about whether we can use one of, you know, the alternative settings maybe as the primary setting. The trade-off we have is like how to effectively make more effective use of the data. The current setup allows us to add more controls at the VC level and at the VC and have the VC fixed effect, and that will absorb more noise in the data. If we try to kind of come up with a consolidated measure for liquidity pressure and one observation for one company, then we kind of lose the variation, the ability to control for certain variations. So it's more kind of a trade-off between, you know, having better controls versus having a setting that is kind of more consistent with the arguments that you are making there.
But on that point, just I don't mean to interrupt, but just real quickly, might you run a series of regressions with each investor? So rather than pick the first, pick each investor and sort of estimate coefficients as if they held control. You could include all those same covariates, and then you would have, in some sense, you wouldn't have a weighted measure, but you would have a sequence of regression coefficients, and if they all point in the same direction, that would be very compelling.
Yeah, that we can also do. Basically, have different coefficients in the same regression, right? It's just different indicators. Yeah.
Ooh, yeah, or different regression specifications with assuming the control is held by, you know, like Sequoia, and then the second regression you assume that it's benchmark, and then this third regression, because if you had like 3 investors, you could sort of assume, you could basically do 3 different regressions, assuming each of those investors is the pivotal.
I see what you mean. So basically coming up with a coefficient for each round of analysis.
Yeah.
Great, both. Thank you. I mean, really great to hear the dialogue between you and Luca and Bobby. That's, I think, exactly what this whole event is about, and really great. So look, I'm just looking in the chat, and I'm conscious we've had a really full discussion, and I'm not sure, I think colleagues are absorbing the discussion, and really rich on many, many levels. So unless somebody is coming in, I'm conscious it's been a long afternoon. I think we leave it there. And that was really couldn't have a better way to finish, both. So well done, super paper, and also to your co-authors who are on the call. Thanks so much again to Bobby and Luca for that really rich combination of perspectives at the end, which I think we all really enjoyed. So can I just take a moment to thank all our obviously our keynote speaker and then our paper presenters and discussants this afternoon. Really rich afternoon on so many perspectives, from policy to regulation to the financial economics analysis right through to the law and this notion of law as a default and how that fits into this really important, and let's see what happens, as credit markets begin to, well, they are shifting as we speak. So a hugely important afternoon. Just before I hand back to Tobias, could I maybe on all our behalves thank the organising committee for this truly superb event, both in terms of the organisation of it, the hosting, the technology that is never straightforward for this kind of event, this multi-jurisdictional, multi-time zone event, superb papers, superbly put together conference, wonderful speakers. It's been nothing but a joy to listen to everybody. So can I thank the committee, Rainier, David, Casimiro, Tobias and Simon. Huge thanks, I think, from everybody, both on the call and who've been with us over the last 2 days. So with that, I think I'm handing back to Tobias. Thank you.
Thanks, Niamh, and you've already basically said it. So the concluding remarks will be very, very brief. I think we had wonderful, engaged discussions, and my thank yous also go out to the speakers, the discussants, and of course, the chairs who've done tremendous jobs. And it's no question, I think, that we all would have enjoyed this event to be an in-presence event even more. But, among the restrictions that we're all facing, I think this was pretty exceptional, because I think we had a very strong focus, and breaking up the thank yous to the organizing committee, we really wholeheartedly have to thank Casimiro, who has done the heavy lifting in curating, and I'm using this term just deliberately, curating this event. But also Simon has done a tremendous job, because I think what we all enjoyed was really the perspective of practitioners who added a lot of value to our discussions. And therefore, Simon, thank yous also go out to you for putting this together on that side. And then I have to thank the other members of the organizing committee, David Kershaw and Rainer Haselmann, for sharing my my approach of shamelessly piggybacking on the efforts of the two that I just named, and not interfering too much with their great work. Apart from that, of course, as Niamh also said, there is, of course, the idea that this is all administered very superbly by some people in the background. And I want to name some of those, which is Alexandra Dirking and Miriam Ducati, who have effortlessly worked not only today and yesterday, but also in the run-up of the conference on making it a smooth experience. And I think it definitely was. And then, last but certainly not least, our friends from the ECGI, Elaine McPartland in particular, and her team, which also made for a very, very pleasant experience. And that's pretty much it from my side. And also, we conclude this day and this conference, I think, with very, very high knowledge gains that I think helps us all to continue our great work. And therefore, I leave you to your whatever you are up to. And thank you very, very much for your contributions and thoughtful interventions. Thanks a lot.
Thank you.
Thank you very much.
Thank you.
Thank you.